All right, well, good afternoon, investors. This is Mark Robertson. I am joined here by my dear colleague, Ken Kavula. Say hello, Ken.
Hello, everybody. How are you this afternoon?
And this is actually, what are you calling it, Ken? A do-over? Mulligan?
A
Uh,
mulligan, a second chance.
a second chance? Because, uh, you know, I, am I allowed to brag that we've only made this mistake once in like 200 shows?
I think you can. Yes.
That's a fairly low error rate, but I actually inadvertently turned off the recording when I thought I was starting it last Tuesday. So what I thought Ken and I would do is just kind of give a Reader's Digest version of this that we can put on YouTube and keep our string of published programs alive and just kind of recap what we talked about. So what I'm hoping we could do here, Ken, is just over the next 15 or 20 minutes, uh, do the Reader's Digest version of some of these slides.
Well, I do think you should explain why all this basketball stuff is on the front slide here, Mark.
Because it's madness, Ken. It's
Because it's March Madness.
it's
Okay.
March Madness. Well, it's part of our theme that's going to come up the movie Hoosiers and a bit of a tribute to Gene Hackman on the upper right. We've talked about him a few times in the past, and we will dredge this back up and talk about this is a key scene from the movie where the wide-eyed youngsters, high school players, are in the state championship game in Indianapolis, and Gene Hackman uses a tape measure to remind them that they're really playing on a basketball court that's just like home. And that's what we'll talk about. And that actually, that exercise gave us George Nicholson's triple play. Oh, it's hard to believe, but that was 50 years ago, Ken. That's,
Well,
I
Mark,
think I got the math right. 1974.
you're getting up there, Mark, and I'm older than you, so
That's, I mean, I wasn't a member yet. I mean, I was still in high school at the time, but that's how far back that goes. And we're also going to talk about this notion that's appearing in much of the media that international investments, specifically Europe and China, are becoming potentially attractive, and we'll just kind of dredge that up. Anything else you'd like to add, sir?
no, I think that I'll add as we go through the slides. Although here's Portillo's. That's a Punchki wannabe down in the corner down there, and kind of a Detroit chili dog wannabe up in the upper corner, up in the top
There's
there.
a whole lot of wannabe going on here, and of course,
Yep.
the chart on the lower right is the Ishimoku cloud for Portillo's, and I'm not gonna pretend to understand it yet, other than I know that more relish on the right is better than more ketchup. So we'll leave it at that for now. All right. You guys all know this drill. This disclaimer applies to this session and any session that we do. No investment recommendation is intended. This is entirely about education and the demonstration of a philosophy, method, and technique made or brought to the attention of a world of investors by the National Association of Investors, also known as Better Investing, and the Modern Investment Club movement. So we're just sharing how we discover ideas and how we deploy them in our portfolios and experience smiles when it comes to investing. So that's what this is all about. So we will be sharing opinions. Please do your own homework before making any decision. If we hold something in a personal portfolio, we'll try to remember to disclose that. And if you have any comments, questions, or suggestions for future sessions, our two email addresses are at the bottom on the page. All right, so let's go ahead, Ken. And this is a quick summary of what the week holds ahead. Now, those are not wannabe punchkis.
No, those are the real thing on this page, Mark. Punchki is a jelly donut on steroids.
Yeah, I
And
brought
they're
home.
really big in Michigan, really big in Michigan. So we're showing them to all you folks from throughout the country.
Yeah, when you go into a grocery store in Michigan on Monday or Tuesday of this week, you are met with a mountain of boxes. And I don't know, maybe they give them away on Wednesday. I don't know. It'd be interesting, but just a mountain of boxes. Ken and I will be on the road to Raleigh, North Carolina this week, and we might even talk about Hoosiers a little bit. And that is just simply a Gentex insert on the far right, giving us that rear view mirror effect. And of course, those two sayings are both applicable to investing. By the way, Ken, when I was telling you about listening to that book, Super Investors, a few minutes ago,
Uh-huh.
what was the common thread that ran through all of these super successful investors? Guess which one of those words down at the bottom he said?
Well, I'm going to guess either discipline or patience, one of the two, maybe both.
And that's absolutely right, both, but with an emphasis on patience. I
Yeah.
thought that was interesting. All right, here's a quick look at our stock market. We feature this week to week. Are all of the above measure of the market as delineated by the value line arithmetic average? That's our reference to an all of the above collection of stocks, small, medium, and large, and how it does over time. And the basic forecast is in that 9 to 11% range right now. And that little insert up at the top, many of the people on the broadcast on Tuesday got this right in the comment field. That's from the wide world of sports. The thrill of victory at that point in the descent. Anything else you'd like to add here, Ken?
Well, no, except to say that it's counterintuitive, but when MyPar, that's the measure of what an average stock return, when it moves down, that means the market's a little bit overvalued. And when it moves up, that means the market's a little bit undervalued. So Mark is pointing to a time right there when the market for a period of maybe not 6 or 7 months there, where the market appeared to be extremely overvalued. I'm sorry, undervalued, and it was a good pickings for the stock market. And then when you see a little bit of white beneath that blue line, that's a time when pickings become a little bit more difficult. So
Mm-hmm.
all in all, it's important for us to take a look at those graphs and kind of keep in mind what we're talking about there.
Yeah, actually, you've got it backwards. The price is
Yes,
high.
I did get
Yeah.
it backwards. I'm sorry, Mark. That's the price bar. The
Uh,
green is the price bars, right?
yeah, if you go by the price bars, when they get up, things get a little bit more challenging. And our premise is that there was a bit of artificial stimulation back there in that COVID timeframe, in the period of recovery. So yeah, your sentiment was right. You just reversed your direction.
A little bit to a lot of incentive spending was going on during that time.
A lot, a lot.
Yeah.
We can graph that too, but we're not going to. Okay, here's our quick check-in on the performance perspective. The point here was that Berkshire Hathaway's not losing his touch. He's still on the leaderboard, despite what some people would like to tell you. He does have a pile of cash. That's interesting, and I'm sure we'll be talking more and more about that. But the 10 stocks that you see here on the roll call are the 10 most widely followed by Manifest subscribers, and they've got a pretty good track record with a couple of frustrating exceptions.
Yeah, Berkshire's on the list to draw your attention to it, but it's not one of the 10 most widely followed. CVS Health is number 10, way down there at the bottom of the list. Cognizant up only 2, and then the rest of them are clumped up pretty near the top of the list, the other 8.
Yep, and there's a number of us in the community that have been a little bit frustrated with Cognizant and CVS, and it's a subject of a number of discussions. All right, so we'll come back to that and talk about that some more. Here is our weekly groundhog update. And my only input here is I remember how pleasant it was to go through last year where all of the numbers on the right-hand side of the page were above $1 million. You start the groundhog with $1 million, and you can see that you get down to 15, and people are actually in the red ink category.
Yeah, that's about an average number of clubs, Mark, we've discovered in the top 40. There's 10 this week in the top 40, and we hit a high one week in the last contest of 12. So we're looking to maybe surpass that in this contest. What I am taking away from this week's chart are the amazing jumps that some people had going from, well, we have one person, the Bogglehead portfolio, which is a professional portfolio, going from 112th spot up to 22nd spot. I find that amazing kind of movement going on. So it's still early in the contest. Just about exactly a month has gone by now. We've got 11 more to go. So I'm hoping we'll see those numbers improve as we move towards next February, Mark.
I think the odds are good, and as you've pointed out in the past, you've got a couple of fellow club partners on the list. In fact, in the top 10. So they may be heckling you a little bit here soon.
Yeah, Mr. Sheets and Mr. Dunman are both in my Wolves Investment Club. Mr. Dunman happens to be my grandson, and he's beating the socks off me right now in this contest. So it's a marathon, though. We had 11 months to go, so we'll see where we end up.
It's early. We only have about 10% of precincts reporting at this point, so very early on. You can see all of the groundhogs on the unofficial scoreboards. The link at the bottom left of the page. The picture of Bill Murray I got when I went into artificial intelligence and asked for an image of a groundhog, and they gave me Bill Murray, so he's there. And there's Warren. And the picture of the buffalo there is just a reminder that buffaloes are notorious for, they don't need a weatherman, but when an intense winter storm is headed in their direction, they actually turn and charge into it. And that way they get it over quicker. So just a moment of inspiration for all of us to get out there and find an excellent company and buy some.
We should point out that that link at the bottom there is taking you to all the groundhog portfolios where you can see what each person has chosen, but it does not include dividends. So the totals are going to be a little bit low for most portfolios. Dividends have to be included to end up with the final numbers for the contest. But it does give you a really great spot to go and look and see what some of the folks up near the top have put into their portfolios.
Yeah, and even beyond that, if you picked a stock for your groundhog dashboard that we don't cover, we basically put a cash proxy into the portfolio, but don't cover it, at least not yet. I'm actually adding them as the days go by, so you can get a differential there also. Quick check in on Buttonwood. And one of the reasons I want to do this, Ken, is to just point out this is not dropping nearly as much as the rest of the stock market. And even though it's been disappointing to us, a little bit disappointing, it's a fresh, brand new 1-year-old portfolio, but it's behaving well, and it's definitely behaving better than most of the portfolios out there. So
I will tell you, Mark, that I've been using dashboards to manage my portfolios now for almost as long as Manifest has been in existence. And I do find out that in negative markets, my portfolios, if I pay attention to my averages and keep them where I ideally would like them to be, I find that my portfolios don't drop nearly as quickly. Sometimes they have a little bit of difficulty maintaining the momentum if you end up with a really hot market. But I think I'd rather have that situation than to have them drop at market percentages or even worse than market percentages, as a lot of the really volatile stocks do.
yeah.
All of the numbers in this portfolio look really, really good to me at the moment. I love the growth at 13+%, and I wouldn't mind seeing it up at near to 14 even. I love the quality number at over 90. I love the par value at 13.6, which is more than 5 above my par. I think, Mark, in the future, we should put a capture of my par in that white real estate right now over beneath Buttonwood Bills so that we can reference it right on the same slide
You can do that.
we take the capture. Yeah. And all in all, the percentages are right where I'd like them to be. And that gives me confidence that if I just have some patience and some discipline, then I'm going to end up with a portfolio that starts to perform and will eventually meet or surpass the market.
All right, here's a quick reminder. Again, this is that all of the above index, the value line arithmetic index or average, and it just depicts how tough the month of February has been. We basically had a wonderful month of January, and we have now given that all back here in the early days of March, and Uh, this is this is normal. I would even dare call it unsurprising, Ken.
I listened to Squawk Box this morning, Mark, and I watched Mr. Kramer just go wildly nuts
Oh
and almost setting his hair on fire. But then I listened to the two uh, counterbalances to Mr. Kramer on either side of him that sit there on a regular basis, and uh, Dom. It's it's Dom Chu, I think. No, that's the wrong one. This is, I'm not going to remember the name, so I'm not going to try to indicate who it was. But he said, we're just a little bit less than 5% off of all-time highs. I don't really see anything to panic about at the particular moment. And he says a normal disruption in the S&P on a normal year is somewhere around 14-15%. So if you're panicking because all the people you're watching on TV are panicking, maybe it's time to dial it back just a
no.
touch.
Or do what I do and unplug it.
That'll work too.
All right, here's a quick look at the Vanguard stock market. In this case, we're measuring it against that orange area on the left image is the all world index except for the United States. So it's a true international fund. This is one we've been talking about a little bit, and we'll delve into it a little bit deeper here in a minute. Um, the European stocks, for example, have underperformed the United States in 12 of the last 15 years. That's not what's happening right now. And it's just something to take note of. The images on the right, and we're not going to go deep into them other than to promise that at some point in the future, we're going to come back and try to have a rational discussion about could this be useful. And there are a number of people within our community that believe that the point and figure chart at the bottom and some of the information up at the top can help with perhaps the timing of a decision or an entry point type decision. So we'll see.
I'll tell you, Mark, there's a lot of excitement about the European stocks right now, but my experience with European stocks goes back about 20 years now, 25 years now. And the European market would have to perform at maybe 20 times the US market for the next couple of years to balance things out in my IRAs, not IRAs, in my mutual funds that I bought a long time ago, thinking that they would add some balance. They
Uh,
certainly have added balance. It's called ballast. And they've added that to my portfolio. So
um,
uh, they have not performed very well at all over a significant period of time.
just want to warn you, if you use that term in front of the Bogleheads this weekend, you might be in physical danger.
Uh-oh.
Ballast. That's good. I'm going to hang on to that. Ballast. Yikes. All right. Moving on before we get in more trouble. I just love this one, Ken. I mean, I know a lot of people that sit around trying to figure out, well, should I invest in March instead of September? Or it's just a lot of energy wasted on it, I'll tell you.
This is one of the three most common questions that I get from random folks that listen to what we're talking about and then send me questions. They want to know what's the best month. They want to know what's the hottest industry, and they want to know if this is a good year. And my response to all of those questions of the same ilk is basically just invest regularly. Don't try to figure out what's the best, because you'll be wrong half or more of the time. And just put a reasonable amount of money in that you can afford on a schedule that's fairly regular. Whether it's once a month or once a quarter or even twice a year. It doesn't have to be weekly. It doesn't even have to be monthly. But if you invest regularly, regardless of what the market is doing, I think you have more than an even chance of coming out ahead.
Yeah, I would spend my time and energy elsewhere. Quick update on this one because it's been a community favorite for a long time. It's kind of fallen into disfavor, but Walgreen Boots has been struggling mightily, and it appears that they will probably be taken private. The point of this is to just basically let people know that if you think you're going to tack on some shares at 10 and get richly rewarded for a premium, the price they're talking about is in that $11 to $12 range. So we're not looking at a huge opportunity here. So just be mindful of that if you think you're going to get cute and make some quick money.
And Mark, if they take it private and then split it up, you're not going to end up with shares of the 2 or 3 or 4 companies that they make
Right.
out of this one giant company. This will not be like the split up of General Electric, which came out smelling like a rose when it was finally all over. But this will be completely different. They're going to take your share of Walgreens, and you're not going to get anything except 10 or $11 for it.
Yeah, it's kind of a fascinating financial transaction if you want to be a wannabe investment banker. I mean, these guys have $70 billion in current assets and $60 billion in liabilities, and the market cap of the company is about 9 or 10 billion. So interesting. The other one that I found interesting that just want to bring to the audience attention, no particular conclusion other than to point out that I'm seeing a lot of this right now, especially in the current issue update, it's issue 5 of the Value Line Investment Survey. A lot of these companies are trailing off in their fair value estimates. And this happens to be from Morningstar, but you can see that red kind of stair-step action on the right side of the image. That is the fair value. And notice how much it's been trending downward, and it's still not keeping up with the ballast on the screen, that stock price that's misbehaving. So,
Moving down much more quickly, yeah.
what you
Mark,
know,
do you think some of it had to do with kind of some exuberance coming out of the pandemic about how we were going to suddenly do a lot better than we did in the pandemic, and forgetting that
yeah,
companies don't really change growth patterns. They might have a real bad bump in the road, but when they come back, they don't really come back as a different company. They come back as pretty much the same company that we had prior to whatever the bump in the road was. So there might have been some exuberance going on in thinking we're coming to the end of this major pandemic problem, and now we're going to grow like gangbusters, and maybe they just kind of overshot the mark to the upside. That's all.
and the other thing that it probably does illustrate is the magnitude of some of the challenges in these international companies. Um, Obviously, this one is down quite a bit. I cannot, for one heartbeat, profess to be an expert on perfume and cosmetics, but these guys are facing some challenges here. I noticed it also with the telephone service providers in Europe. You take a look at that, and you can see. Maybe I'll put that together for next week, Ken. You can see in one quick snapshot, what the economic challenges seem to have been.
Yeah, I don't really follow Estee Lauder, Mark. Is it an American company or is it a French company?
It's European. I can't tell you exactly where they're
It
headquartered.
is a European company then. Okay.
hmm I think that they might be headquartered in the United States, but they've got a lot of international business. At least I believe so.
Yeah, I know that
I
they
should know.
sell worldwide. It's a worldwide brand, and I know they have heavy duty sales. When I was doing my work on Louis Vuitton and doing some
Mhm.
preliminary research there, I knew that Estee Lauder was a strong competitor, especially in Southeast Asia. So
Yep. So we'll continue to watch that. Be mindful. And I did get a question after the session about uh, why do I care? One of the things that this is actually going to have an influence on is PE ratios. Believe it or not. What you basically would see happening would be the PE ratio as interpreted by the analyst consensus would be getting trimmed. So if that's one of our inputs. It's one of our inputs, so it's a trimming of the PE average. Um, One of the company that we briefly discussed was Warby Parker. This is early stage, should have a big red banner across the top warning, but Matt Spielman presented a compelling argument that this is quite a field of opportunity with Luxottica controlling about 85% of the market and selling some fairly expensive eyeglasses at a number of venues. And these guys are coming on. And you can see that they are steadily marching. when it comes to revenues. And this is also a potential breakthrough or a launch pad opportunity with the company just breaking through to potentially positive earnings this year.
The most compelling fact that I heard Matt talk about, Mark, was that Warby was going to be looking to put some of its mini stores inside Targets. That was something that I thought maybe would drive a lot of profitability, since they wouldn't have to really invest in any kind of real estate other than perhaps leasing space from the Target that is leasing space from somebody else, you know?
Mm-hmm. Yeah, and that is just started, and they do actually have some Target locations out there, so be interesting. Then Matt also mentioned this. This wasn't in the show on Tuesday, but I threw it in just so people would see what they're looking for. This is a good discussion of the innovators and disruptors that are the CEOs of the company Warby Parker, and it's a good discussion of the industry, and I think well worth a listen. If you're not familiar with Freakonomics, it's an entertaining podcast. Ken and I will probably take that one on when we are driving between here and Raleigh. All right. And here's another reference to those international companies that, seem to be worthy of catching our attention. All this is a list of ADRs that have pretty decent return forecasts calculated two different ways, and decent as in good or excellent quality. And pretty good list of companies to at least give some consideration. You agree, sir?
Well, not only do I agree, Mark, but I agree that the top half of the list, at least from Nice to Novo, gives me some companies that I think have pretty decent looking SSGs as well. I think that there's some interesting studies there. Taiwan Semi. I own Taiwan Semi. I own ASML. I own Novo Nordisk. I own Nice, and I think that you could do a lot worse by not studying some companies that are foreign. I have a personal preference against staying away from China, so that puts a big red line through Luckin. But I've presented some of these
BYD too.
companies I presented some of these companies at the round table, and I have faith in some of these companies. Yeah.
Yeah, in fact, Opera was my selection 2 months ago for the roundtable, and Opera
Yes, it was. All right.
it's basically the non-US Google, is the
Yeah.
way to think of it, and with emphasis and targeting of gamers. There's a lot of gamers out there, everybody. Of course, the other one that we've talked about in the past that one of these days I'm going to really dig in, Ken, is figure out why didn't Fuji go the way of Kodak? It's just a question. And here's some of those international influences that the experts keep pointing to. This is a Morgan Stanley summary. Morgan Stanley, pretty good track record that we have featured in the past. And there's geopolitical stuff that may be calming down, and maybe some relaxation of some of the energy price challenge out there also.
Yeah, the Mid-Michigan Model Club, Mark, is zeroing in on that number two, that higher defense spending. And they're in the middle right now of a aerospace and defense industry study. And we're kind of fascinated by the point that the value line timeliness rating, which is something we don't normally take a look at, for a lot of defense contractors is 3, 4, or even 5, which means it's not particularly the kind of company you'd want to invest in for the next 6 to 12 months. But the closing paragraph of our top 6 contenders in the study, the closing paragraph is very, very optimistic for the 3 to 5 year run for these defense contractors. So we might be looking at an industry that is not particularly loved at the moment, but has a huge amount of potential going forward.
Well, I was listening. I don't do a lot of this, but I was listening to Bloomberg earlier today, and there was a fairly compelling, I don't remember the gentleman's name, but he was talking about how we should expect some dislocation with, for example, Lockheed Martin might actually have a drop off in business as some of the European companies like Leonardo are kind of ramped up by spending by Italy, Germany, Britain, France. And so there could be a tiny bit of dislocation. But then he went on to say, but what happens when the European defense companies basically max out? And, when their shifts are completely, when they're going as hard as they can, that will result in a restoration. So it's a temporary dislocation that he would expect for some of the United States domestic aerospace and defense companies. And then he also pointed out that the speech the other night by the president mentioned this Golden Dome that actually has some pretty far-reaching implications for these companies in a good way also. So those two factors are a reason he said, don't worry about the temporary dislocation that you see here, and have a longer term outlook.
Well, I'll just piggyback on something you just said too, Mark. In our study, we're looking at a couple of companies out of the 6 that provide materials to all of the defense
Good
contractors
idea.
in the world. So that even if Lockheed Martin drops off a little bit, a company like HEICO, HEI, which a lot of folks don't even know about, probably is going to maintain its business or even expand its business because it sells pieces and parts to aircraft manufacturers all over the world. So, it's a
Well,
different way of looking at an industry, but it's definitely part of the same industry.
well, I thought we were going to spend 5 seconds on this slide, but I'm going to piggyback on your piggyback and point out that shipbuilding was also mentioned. So somebody who sells stuff to shipbuilders, that's also worthy of consideration.
How
And
about HII?
there you go.
Take a look at it, folks.
Yeah.
HII. Another one of the 6 in the study.
And then I had one more thought, but I'm not going to be able to remember. With all of this nuclear, small modular reactors, there are very few companies that can actually put together the pressure vessels. I used to work for one of those companies, and our domestic manufacturing in Chattanooga was shuttered a long time ago. So there's that BW TX company out of Lynchburg, Virginia, who actually provides a lot of stuff to the Navy and private ship companies. So good stuff. All right, so much for 5 seconds on that slide, Ken. Well, we'll give this one 5 seconds. Here's China. China's doing better. Some very pronounced and celebrated super investors are investing heavily in China, and we're just simply scratching our heads and wondering, what are we missing? So we
Mark, I've
can.
heard the same thing, though, from 4 of the people that I really, really respect. And what they've said is that they feel that while China is going to be trying to jumpstart their economy, which is having some issues right now, they all were afraid that they were going to try to jumpstart back into manufacturing again, which has led them down the road of having the declining economy because they don't have the consumers to deal with all the products that they manufacture. So there's kind of a catch-22 built into the way that the economy is being managed right now. And yes, they're beating U.S. stocks at the moment, but this map, for example, doesn't bother me, Mark, because China exports so many things that are I don't want to use the word frivolous, but they're really kind of minor. And yet they're the kind of things that people can consume and they want cheaply. If you want sweaters or underwear or novelties or
Mhm.
stuff like that, and China's going to supply it to you, and the U.S. has gotten out of
Yeah.
manufacturing a lot of that kind of stuff. We got out of that probably when we faced the problem of all that stuff coming from Japan back in the 80s and 90s.
Yep. Well, I'll tell you, it's even simpler for me, Ken, and it doesn't amount to imaginary factories or anything. But when China decided they weren't going to buy any more of my A2 milk and banned it from children's formulas, it wrecked my roundtable call on A2 milk, and I'm not ready to forgive them yet.
Okay. At least A2 milk existed.
Yeah, well, it still does, but
Yeah,
they definitely brought that parade to a halt for a while at least. All right, here's
yeah,
just a quick way, courtesy of Bloomberg and Barron's and stock charts, some ways to invest in Chinese stocks, and you can see there is some valid consideration that these guys have been. Chinese stocks in general have been pretty sluggish for 10 years, and that just aligns with that international, there's that word again, ballast situation for the last several years. And the iShares down at the bottom might be a way to diversify an investment. I definitely would think large cap if I were to go there. All right, you ready for the next wrap up shop here?
well, there's that butt again. Okay.
The butt, the butt is back. Well, that's Gene Hackman standing on the middle of the floor at Butler University's, and he's got a tape measure, and he's having the young high school basketball players measure the distance from the free throw line to the rim and confirm, gee, it's still 15 feet. And then literally one of them gets on the shoulders of another player, and they measure that the basket is indeed 10 feet off the floor. And his reminder was that is just like home. So keep that in mind as we go out there and play our game. So this is actually an article that I wrote back in 2009, and you can get the full article at the link on the lower right. But this is actually some pretty cool stuff. A lot of times when we're faced with a market where it becomes challenging, it becomes hard or challenging to be enthusiastic about shopping for stocks. Now, I know many of us, including Ken and myself, that doesn't happen to us very often, but every once in a while it kind of sneaks in. I just love this sentence here because we worked with a lot of investment clubs that were pretty frightened back in 2008, 2009. And Nicholson talked about this measure what's important. Seek the opportunities, be focused on the metrics and characteristics that matter the most to us as long term investors. And if you do that, it can be an antidote to the poisonous paralysis that afflicts so many of us as stock prices decline. In fact, Nicholson pleaded with investment clubs to continue investing regularly during early 1975. And then he actually went through a case study of Coca-Cola where he described what has now come to be known as his triple play. And the triple play is a pretty simple concept. You find basically a company that you have vetted, believe in, and trust that has had its stock price um, basically hammered so that the stock price is down, yet the company exhibits the characteristics of where they could potentially experience margin enhancement and or PE expansion. And that's what this article was about. I would just encourage you anytime you're having one of those poisonous paralysis moments, pull this one up, get out and take a look at it. Because if you can find these type of opportunities, I think you're better off. Now, Ken, we actually talked about these type of opportunities at the Lansing conference back in 2009. And
absolutely.
and I still, it gives me chills to think about how well some of those companies did that we described to the audience. So I'll let you go ahead and describe
Well,
how.
Mark, the question that I get more than any other about triple play is how do you know when the stock price has been hammered? And the answer I give is I like to look at a value line sheet or some other instrument that's giving me projections, at least 3 years into the future or longer. And if those projections make me smile, then usually that means the stock price has been hammered. And when I see projections on YETI Holdings of a low of 12% annualized and I have 24% annualized, those make me really smile. The double digits help to bring that smile to my face. So that's number one. Number two is you're checking the PE ratio at the top of the value line page, and you're comparing it to the 3 to 5 projection over in the grid. And Mark has that circled with the smaller of the two circles, 13.4 up to 16. That's PE expansion, and that should make you smile as well. And then the last thing you look at is the last 2 or 3 years of actual operating margin. Mark has those circled. and then compare them to the 3 to 5 year forecast for operating margin. And if the trusted source is forecasting an increase in operating margins, then that should make you smile. And there's your three legs of the triple play.
Yeah, and I would actually add that you can look at the chart, the stock price chart. We're not technical analysts, but Arnold Bernard gave us, he's the originator of Value Line, gave us permission to compare the current stock price, that's the dark dot shown here on the upper right, versus this theoretical price forecast trend line. And anytime that there's a gap and the price is lower, you've got a situation which backs up Ken's double-digit total return forecast. Good stuff.
That is the Mark's pointing that top arrow is pointing to the value line, hence the name of the whole shebang.
Yeah,
That's the value line right there.
the value line.
Right.
And then this is that thrill of victory became the agony of defeat. Kind of hard to see what's going on there, but that's a skier in a bad place. And it's a work in progress. Back from ABC, and then that led to this one. I was inspired to pull this up by Ken's description during the Getting Started classes last weekend. Take it away, Ken.
Well, this is Zoetis, and Zoetis to me was just a primary example of getting out over your skis and having a rough patch. Look at the tops of those I bars moving into the pandemic. The price was just moving way too quickly compared to how the sales and the earnings were moving. And I firmly believe that earnings follow sales and stock price then follows earnings. The stock price was not coming anywhere close to following the earnings, which were in fact following the sales pretty nicely. And when you get ahead of your skis like that, you have a moment where you kind of crash a little bit, and then you kind of stabilize down on your knees or on your back, or maybe even you stand again, but you kind of stabilize.
I just stay down.
Meanwhile, the price keeps, the sales keep growing and the earnings keep growing. We've seen this in a number of different stocks before. I think Mark mentioned at the session last Tuesday that Home Depot was a beautiful example of a stock that gets a little bit aggressive in its pricing and moves a little bit too quickly, and then has to kind of tail off for a year or two and kind of level out. Meanwhile, sales and earnings keep increasing, and then it takes off again to catch back up. So I thought that Zoetis was a good example of a stock that got over its skis, that had some issues in price. It didn't really have issues in sales or in earnings. And I think that was a primary example, especially if you look at the most recent iBar, it's trading near the bottom of its range. I think it was a great stock to study and to take a look at going forward.
Yeah, don't you dare say what's not to like.
I didn't.
Hey, I got an email this morning. This is probably a future topic. You're going to love this one. It basically said, well, noting Ken's comments about companies being over their skis, is Costco over its skis? And are you guys too emotionally attached to it at the round table to give it a fair analysis? How's that for a question?
I honestly think that if we were actually dealing with this portfolio, and if we had more than a single position in Costco, I belong to an investment club, Mark, that cut its Costco holdings in half.
Oh, you're way ahead.
So we listened to what George Nicholson said about being very careful when you have stocks that grow their sales around the 9-10% or plus range. Be very careful about cutting them out of your portfolio entirely, but maybe cut them back when the when the PEs have expanded beyond where you feel is reasonable, and where the profits are very large. Maybe you have to take some of those profits sometimes. And I know if you've fallen in love with the stock, that's very difficult to do.
All right, future assignment, we'll be taking a look. Here's a summary of the 3 classes that Ken presented on Saturday. The Mid-Michigan chapter went through and delivered these three classes on the core SSG, the SSG Plus, and then some implementation and portfolio design and management. Some good stuff. Those are available on the Manifest Investing homepage with links to the YouTube sessions, and the decks are actually there also, the discussion decks. All right, so Ken, here's just a little bit of a capper on the triple play thing. We do feature the triple play as a screening criteria at Manifest Investing. So I just simply said, well, I'm just curious what's out there right now. So I said, well, show me companies that are triple play candidates that happen to also be in the sweet spot. That means that they are. This is what Ken was asking for on Buttonwood a few minutes ago. Basically, return forecast in the 15 to 20 range. That's probably going to place it in the buy zone of most stock studies. So being in the sweet spot, and let's only settle for excellent companies, top quintile. So the quality of 80 down here is the minimum condition. And I'm just not ready to deal with companies that are a little bit slower. I'd like to keep the growth up. So double-digit growth, you get a pretty good list of companies to study.
I ran a very similar screen, Mark, got 5 of the 6 that you have listed, and found out that I owned 3 of the 5. So the other 2 were definitely on my list to take a good hard look at, because I'm very pleased with my holdings in Green Brick, Axos, and YETI at the moment. So I'll be looking at Top Build, BLD, and Skechers. BLD is owned by one of the clubs I belong to, but I've never given it much of a second look. And I'm coming up in the triple play screen right now. I'm going to take a hard look at it. We have a very astute insurance agent in my personal investment club, and he has kind of led me to think that the insurance stocks might not be the best kind of investment for a lot of folks. So I'm going to be staying away from Mercury General, but that's a bias that I have because of an insider telling me that it's hard to make money buying insurance companies.
Yeah, and I'm not 100% on this, but I'm pretty sure that Mercury General has a material exposure, I'll just put it that way, to the California incident. A fair number of homes were apparently still insured by Mercury General, so they've got some. And I'm not 100%, but I
Well,
think
and I
that
don't
could be
look
the
at
case.
the yield column very often, but a lot of times I think people put insurance stocks into their portfolios as a dividend investor, not so much as a growth investor. So
Hmm.
uh, I don't know very much about the company, and I'm not bad mouthing it. I just am going to stay away from it. That's all.
Hmm. Yeah, we're going to do something on insurance, life insurance here in the future with Hugh McManus's comments about Aflac and the extremely provoking thought of what if a cure for cancer is found? What happens to these companies with a lot of cancer insurance? So we'll come back to that. Here is YETI, and you can see that they have been sluggish here for the last couple of years. A lot of competition, but these guys seem to be holding up pretty well. This is a Barron's article from the recent past, and we're basically going to use this as an opportunity to look at one of the original. It is the original stock selection guide in Better Investing when it was still known as the NAIC Bulletin. Now we've used this several times, Ken, and I'm one of these days I'm going to find a way to get a copy that isn't so cloudy. We can actually read more of it. But the point here is that I don't know what George Nicholson would do today, but I know that George was behind the original stock selection guide. And when the original stock selection guide came out, they completely emphasized sales and pre-tax profit or pre-tax income on the guide. at virtually the total exclusion of earnings back in the early days. So I find that kind of interesting that was his initial point of emphasis over these. So I thought what we might do is take a quick look at YETI, and I was inspired by your session on the core SSG on Saturday, Ken, just to take a quick look and a walkthrough. Jump in where you need to, but literally just taking a look at the last 5 years or so of YETI, you end up with a growth rate somewhere in the 12 or 13% range, as is shown here. And then we're just quickly taking a peek over at Value Line to say, is that in any way consistent with the two? I would say those are the same number. So I'm fairly comfortable thinking of YETI as basically a 12% growth company. And then I sneak a peek over here and say that, well, the last 4 years have been at 14, so last 5 years, excuse me. So that's also an input to my brain as I think through the study of the company. And again, first thing first, for any company that you study, what is the top line doing? O'Hara said that this is the straw that stirs the drink. You want to have a good understanding. I think the tool does a great job of pegging expectations for YETI. Any comments?
No, I think you hit all the high points right on the head, Mark.
So that's number one. And again, keep in mind that we were talking earlier about patience and discipline. Here we're on the discipline part. Pay attention to what the track record is and the reasonable, there's your word, Ken, reasonable
Yep.
expectations for the company going forward. So that's point one. And you only have a few milestones or key characteristics to look at in the course of any study. And this is the big one. Second is the profitability. And again, we're using one flavor of profitability here. This happens to be the magenta, or the pre-tax profit on sales for the company, and you can see that it's fluctuated around a little bit, but it does seem to be somewhere in that 14 or 15% range. And sure enough, the calculation by the tool does check in at about 14, as you can see right here. So 12% growth company checking in at a 14% pre-tax profit going forward. So again, as another checkpoint side by side, that operating margin is going to have a couple more things in it. So it's going to be a little bit higher typically, but we want to see the same type of pattern. And I would argue that you do see a high degree of correlation in the pattern, at least. So we're talking about a company with an operating margin, something closer to cash flow in that 20% range. The other thing that I wanted to really point out to the audience, because I get this question a lot also, this 2600 that you see here is literally the estimate for 12/31/2028. And as we're doing a study currently, that would be nearly 2 years different from the number we'd be kicking around. So you want to keep that in mind. That number is dramatically different. It's simply because, doesn't mean it's wrong. It does not mean it's wrong. It just means that it's a different point in time. Any thoughts?
Again, you hit the high points.
Okay, so we thought we would demonstrate how this would go into a projected return on value calculation. And I'm not showing it here, but we're going to take a look at the inputs to a projected return on value. So again, keeping in mind that 2600 number on the first page, we want to figure out what's our expectation for sales 5 years from now. So we take the trailing 12 months at 1840 of a value line or from the Morningstar data and escalate it by 12% per year for a full 5 years. That would be like taking 1840 and multiplying by 1.125 times. And that gives you this number, which is 3.2 billion. Not 2600, 3.2 billion. Okay? Then we calculate our pre-tax income by taking that number and multiplying it by that 14%. So we're basically looking at the answer to the question, if I were to buy the entire company, YETI, go out this afternoon, take out a home equity loan and get some money from Ken, and and I bought the entire company, this is the cash flow that I would expect 5 years from now. It's kind of like if you're buying a property, you look at, what's the property going to be worth and what's the rent and all that stuff. So treat it as a full ownership situation. That's what I would be getting into. So we have to compare that against, well, what's the total value of the business? We refer to that as the enterprise value. And it has three basic components. The first is the stock price, the market cap. Now, again, here's a place where you want to be a little bit careful. If you go to Value Line and you look at what is the market cap, it says 3.2 billion, but don't lose sight of the fact that it's a October price. So if you calculate it based on $34 instead of the current price of 30, the current price is 34, it was 37 back here, times the number of shares outstanding, you get a slightly different number. So 2856 instead of 3200. Total liabilities, this is the Greenblatt modifier that we really pick up on in the Greenblatt magic formula. He used total long-term debt. And we figured out, and this was a real aha moment for us, we figured out if you use total liabilities, you no longer have to worry about long-term debt, current liabilities, and lease obligations. And you don't have to play around with all three of them. You just simply are answering the question. If I were to buy this company using the money that Ken loaned me this afternoon, these are all the total liabilities. I don't care whether they're long-term debt, lease obligations, or anything else. That's what I would have to address as the owner of this business. So total liabilities is the second. So it's market cap plus total liabilities, and then we correct for the amount of cash in the company's wallet. In this case, they have $280 million in their wallet or checkbook. And then you fill those numbers in so that, again, that cash flow that I would expect 5 years from now, divided for what I really have to pay for the business, is the projected return. And the projected return in this case checks in at 14.5%. Anything you'd like to add, sir?
Only that 14 and a half could then be compared to a PE based return value, a par value, which we're a little bit more accustomed to. And if the two numbers are reasonably close to each other, then you've gotten validation for all your work.
Absolutely. And that's what we're going to do here. Again, I want to make the point that you can get the only place, one of the few places I can get to this very easily is in Morningstar under the balance sheet. Go get this 546. You will not find this number on the Value Line page, this 546. So the most reliable source I've got as a public source is Morningstar. To get to that total liabilities, you need the total number. And here we go. So let's do what Ken said. Here's a look at the company. Again, come back to what we talked about first. This is that first major milestone. Take a look at the operating trend for the company and answer the question, what do you expect? Given the field of opportunity faced by this company and the trend, I'm up for a 10 to 12% type expectation for YETI. How does the profitability look over time? Well, here's a look at it from both a bottom line net margin and a cash flow or operating margin perspective. They should be parallel and they should track. And I'm comfortable with this company is a leader in its industry and it's under competitive attack from a number of companies, but it seems to be plateauing out when it comes to operating margin in the 18 to 20 range. That net margin is down in the 10 to 12 range. All cool. And we're looking at a company that has an excellent quality rating up at the top of the page, taking all the factors into consideration, financial strength of the company and everything else. And then we also see that it's trading near a multi-year high when it comes to the return forecast. So that 14 or 15% projected return on value, and here are all the numbers, compares pretty favorably. Well, if you do a stock selection guide on the company, you're going to come up in that 15 to 17% range in most cases. And that's what we'll take that next step at a future bull session and take a look at both. But you can see the picture here pretty well, I think. Anything else you'd like to add, Ken?
No, I don't think so.
And that 18 does wedge itself in right here pretty well. So with that, we'll just remind the audience that, well, now we won't have a broken chain here. All of these sessions are archived at the Manifest Investing YouTube page. And along with those 3 sessions that featured Ken last weekend, all 3 of them are right here. And we do include our roundtables and other programs from around the community that we participate in and keep them as available to you. If you do hit the subscribe button and subscribe to the YouTube page, we're not going to send you a bill. It's free. But what that does is anytime that new content is added to the page, you will be made aware of it. So with that, Ken and I are going to be heading to Raleigh here in a few minutes. Look forward to that session, and the slides and everything will be available. You can attend remotely. There is a link right on the Manifest Investing page if you want to take a look at that. And we hope to have I know we'll have a good time on Saturday morning in North Carolina.
We always do, Mark. We always do.
And that, like I said before, Ken, that's how we'll know we're getting close when we see that. And that's good for now. Any closing thoughts?
No closing thoughts except to say thanks for viewing this on the YouTube site, and good afternoon to everybody.
Good afternoon. We didn't make it to a Reader's Digest version, but we'll keep trying. Okay. Thanks, Ken.
Thank you, Mark. Bye-bye.